All right, welcome everyone at our first public analyst call. We're going to be talking about the outlook for 2021 and also do a little bit of an overview of what's happened last year. We at the Block Research, what we do is that we track all the data, all the developments in the space. We write data-driven research, and we really cover massive amounts of topics. Mostly lately, we focused on DeFi, stablecoin, CBDCs, custody, investor portfolio maps, ecosystem maps. We also cover infrastructure and companies. We do this for our members exclusively. So a part of the package is that we have a daily newsletter where we deliver all the content. We also have exclusive live events, monthly analyst calls. This is the first public one, but we normally do these only for our members on a monthly basis. And you also have direct access to the Block Research team through the Slack account. So if you haven't yet become a member, and if you do want to, we have custom pricing for enterprises and for one-seat licenses as well. So you can reach out if you're interested. So first of all, this is the team that we currently have. We now have 8 full-time research analysts, aggressively hiring. So if any one of you have any leads or any recommendations, please forward them to me directly. And we're also at this point we have 8 full-time research analysts, but also 2 research interns and hiring on that front as well. So if you have any leads in either of those, please reach out. And so first thing that I want to start with is just remind everyone of the content that we've put out previously. The 2020 year in review is really something that all of you should check out. It's an interactive overview of everything that's happened in the last year, and it's really just super easy to skim through and send to your friends, send to anyone who wants to catch up quickly on what's happening in crypto. And then we've also released the 2021 Outlook report. A lot of that is going to be summarized in this presentation. But if you're interested, that one obviously goes way more in depth. It's a 100+ page report, also great to just print out and read through over the weekend. So these are the 2 great things that we've released recently. Another thing that I want to quickly mention is our data dashboard. If you haven't checked it out yet, that's also free, available for everyone. We now have like nearly 200 charts, constantly adding more, and working with 10+ data providers. So if you have any suggestions for the data, we can add new charts fairly easily, and we're welcoming any feedback that you guys might have. So on this call, we're going to be talking about 4 main topics. Lars is going to start with the state of the market. This is going to be a section that basically looks at all the macro indicators and updates you on what's been going on, all the data we track basically, and how it's been developing. Then Ryan is going to be talking about the public and private market activity, and then Mika talking about DeFi, and finally Mike Rogers about the Stable Act, which is obviously really important to the development of stablecoins. Before we start, and I'll hand this to Lars, I want to remind everyone that towards the end of this call, we'll also have a 10 to 20 minute Q&A session. So throughout the call, please ask as many questions as you want through this platform. There's a question tab, and we're going to try to answer as many of them as we get. Obviously, we might not get through all of them, but ask as many questions as you can, and we'll get through all the ones that you find the most interesting. So now I'll give it to Lars, who's going to be talking about the state of the market, and we hope that you enjoy this.
Perfect. Thank you, Larry. Yeah, hi, guys. For the state of the market, we will briefly go into the December numbers for last year, as well as the all of 2020 numbers, starting with the most important ones, actually. What was very clear last year is that basically we reached new all-time highs in most of our metrics that we measure, and that crypto truly has become a $1 trillion market asset class, right? And we even reached the $1 trillion market cap this year. So in terms of total adjusted on-chain volume of stablecoins, actually, for the first time ever, they reached the $1 trillion mark and came in at 1,061 billion. And of that, Tether is leading with about 72.8%, followed by USDC with 15.1%, and DAI with about 6.5%. So you can truly see the dominance of Tether in this one. And I think that the second most remarkable chart for last year is the total legitimate volume of spot exchanges, which also surpassed the $1 trillion mark again, as it did in 2018. But this time it's a new all-time high as well at 1.82 trillion. And remarkable, Binance itself surpassed the $1 trillion mark with about 1.077 trillion dollars in traded spot volume. Going into the adjusted on-chain volume, overall, total adjusted on-chain volume saw a strong increase of about 33.5% in December, from 204 to 272 billion, which is a new yearly high. And Bitcoin's on-chain volume itself increased by 40%, from 136 to 190 billion. And as for Ethereum's on-chain volume increased by roughly 21%, from 68 to 82 billion. For 2020 as a whole, the total adjusted on-chain volume increased by 351%, from 60.3 billion in January to 272 billion in December. And why is it important? Because the total adjusted on-chain volume is basically used by us as an indicator of economic value and economic output on the respective chains. And if we include stablecoins, we can actually see also where value is settled on the blockchain. And while Ethereum is still leading Bitcoin as settlement layer, Bitcoin also rallied to quite strong actually in December, and specifically in H2 of 2020. And overall, at the end of December, with stablecoin volumes included for both, Ethereum only settled about 1.2 times more volume than Bitcoin, which is quite remarkable. But for 2020 as a whole, Ethereum settled 1.3 times more volume than Bitcoin. And taking into account the total adjusted on-chain volume as a whole as well for 2020, it also surpassed the $1 trillion USD mark and came in at 1.42 trillion, with about 1 trillion sharp for Bitcoin and 402 billion for Ethereum. Going on to the stablecoins themselves, in December, stablecoin supply grew from 24.8 to 27.9 billion, which represented an increase of 12.5%. And for 2020 as a whole, the total stablecoin supply has grown by nearly 375%. So that was also quite remarkable, especially given an H2 following July, August, and the DeFi rally in summer, basically. And in terms of adjusted on-chain volume of stablecoins, the previous all-time high from September, which was the top of the summer DeFi rally, was again surpassed in December. So we reached a new all-time high there as well. And we grew by about 20.8% on a month-over-month basis from November to December, from about 147.5 billion to 178.3 billion. And as previously covered, the adjusted transaction volume of stablecoins, which we noted transaction volume previously, surpassed the $1 trillion mark. As for velocity of stablecoins remained mostly stable in December. What's notable here is that DAI's velocity still remains far below its September high of 23.9, which we use as an indicator for, especially specifically for DAI, for DeFi activity. Going on to miner revenue, Bitcoin miners generated about 692.3 million in revenue in December, which represents a month-over-month increase of 32.7%. And for 2020 as a whole, Bitcoin miners generated about 5 billion in revenue, with the split being 4.68 billion in subsidies and about 320 million in fees. And on the right side, you can see the same chart for Ethereum. And in December, Ethereum miners generated about 371.5 million in revenue, which is a month-over-month increase of 29.7%. And for 2020 as a whole, Ethereum miners generated about 2.1 billion in revenues, with about 1.53 billion in subsidies and 567 million in fees. If you see the chart on the bottom, there we basically track the share of fees as a percentage of total miner revenue. And what's really notable here in startling is the strong rise of the percentage for Ethereum on a 30-day rolling average for the DeFi rally, as we can see here, topped out at almost 50% in September. But as a whole for December, transaction fees as a share of total miner revenue on Ethereum grew to around 28.4%. And for 2020 as a whole, the average of that was 18% for Ethereum. And on the flip side, for Bitcoin, transaction fees as a total share of miner revenue actually slightly increased in December, from about 11% in November to 9.5% in December. And for 2020 as a whole, the share of fees as a percentage of total miner revenue for Bitcoin was about 6%. So Ethereum keeps leading here very strongly, which is to be expected given the on-chain activity and the very high gas fees that we can observe in the last few months.
Lars, sorry for jumping in, but if you can mute your notification, tap right, because everyone can hear them.
Okay, let me just see. Perfect, that should be it. Great. Following, going into cryptocurrency exchange web traffic, overall web traffic for crypto exchanges came in at around 1.47 billion for 2020. That's a new all-time high, and given that we only record the volume since April 2019, it's actually the first yearly number that we have on this metric. And overall, web traffic saw an increase of about 23.5% in December to around 196.2 million website visits. And that itself also on a monthly basis is a new all-time high since the time we started recording this metric. And for 2020 overall, from January to December, web traffic increased by about 110%, from 93.4 million in January to about 196.2 million in December. And going on to the market share of web traffic, actually, Binance and Coinbase continue to lead with about 28.7% for Binance and about 24.5% respective market share for Coinbase, which is especially startling given the large difference in spot volumes. And notable, we can also see here the decline of BitMEX in percentage of web traffic, as well as Upbit, Innodex, and Bithumb's web traffic numbers, which highlight the continued potential of the Asia-Pacific region in this regard. Going on to spot volumes, as previously mentioned, where we had the yearly charts, spot volumes reached a new all-time high in December and increased by about 30.5% from 294.2 to 384 billion, and actually broke the previous all-time high set at 343.3 billion at the December 2017 high of the previous rally. And yeah, they surpassed the 1 trillion mark as previously noted. Interesting here is for 2020 as a whole. Binance had an average market share of about 58.3%, followed by Coinbase with an average market share of about 10%. And yeah, the interesting part is the difference in web traffic, where they're almost equal compared to spot volume, where they're quite different. Going into DEXs, which have been a very hot topic in 2020, DEX volumes recovered in December to around 23.3 billion, which is a month-over-month increase of about 36.5%. And really notable here is that SushiSwap was able to increase its market share from November to December from about 11.7% to 13.2%, and replaced Curve on the second position behind Uniswap. So right now the positioning is Uniswap, SushiSwap, and then Curve. Previously it was Uniswap, Curve, and then SushiSwap. And in 2020 as a whole, DEX traded an aggregate volume of about 107 billion, which represented on average about 5.8% of aggregate centralized exchange volume. And taking the January and December numbers, the overall DEX volumes are up at about 3,890%. Yeah, going into the monthly ratio between decentralized exchanges and centralized exchanges, you can see that from November to December, it almost flatlined at about 6%, which is very close to yearly average, as mentioned previously, of about 5.8%. Going on to derivatives, starting with futures and then options later. There were new all-time highs across the board in December 2020 for all of our measured metrics. Starting on the top left with the aggregate open interest of Bitcoin futures, they reached a new all-time high of about 9.5 billion by the end of December, which represents a 30% increase month over month compared to November. Going to the top right at the monthly volumes of Bitcoin futures, they saw about an increase of 20.8% in December and hit a new all-time high of about 1.06 trillion. And for 2020 as a whole, Bitcoin futures traded an aggregate volume of about 6 trillion, which is up 169% from January to December if we take the monthly numbers. Following on to Ethereum futures, the aggregate open interest of Ethereum futures reached about 1.58 billion by the end of December, which is a month-over-month increase of about 21% compared to November, and also a new all-time high. And finishing with the monthly volume of Ethereum futures on the bottom right, They grew slightly by about 4.4% and had a very strong month already in November, from about 246 to 257 billion, also representing a new all-time high since we record the metric. And as a whole, in aggregate, Ethereum futures traded about 1.47 trillion in 2020. And taking the monthly numbers from January to December, that represents a growth rate of about 527%. Going on to ratios, Bitcoin futures continue to outperform, obviously, Ethereum futures in both trade volume and open interest. And tracking the ratio between Bitcoin and Ethereum futures volume itself, for December, that came in at about 4.13 times larger for Bitcoin over Ethereum. And for 2020 on aggregate, that was about 4.8 times for Bitcoin futures over Ethereum futures. As for open interest, in December, the open interest of Bitcoin futures was about 5.9 times larger than the open interest of Ethereum futures, and it's very close as well to the 2020 average ratio, which was 5.8. Finishing with options, the same for futures. Options saw new all-time highs in December for all of our recorded metrics. Notable though is that the aggregate growth rates of options were actually much higher than the growth rates of futures. And the story of 2020 really has been options growth. And starting on the top left again with the aggregate ownership of Bitcoin options, it reached a new all-time high of about 6.8 billion by the end of December, which represents a month-over-month increase of about 43%. Compared to November. And the monthly volume of Bitcoin options on the top right also reached a new all-time high in December. It increased by about 26% on a month-over-month basis, from 14.2 to 17.9 billion. And for 2020 in aggregate, Bitcoin options traded about 67 billion, which is up 940% from January to December. Finishing with Ethereum options, the aggregate open interest of Ethereum options also reached a new all-time high in December of about 901 million by the end of December, and that represents a slight month-over-month increase of about 2.8%. The same for futures. Ethereum options already had a very strong month in November, so the growth rate was markedly less than for Bitcoin, which broke its all-time high, 20,000 in December. And the monthly volume of Ethereum options on the bottom right also reached a new all-time high in December. It increased by about 19.9% on a month-over-month basis, from 1.61 billion to 1.93 billion. And in aggregate for 2020, Ethereum options traded about 7.7 billion in volume, and they are up about 3,410% from January to December. And comparing options to futures, what's noteworthy is that Ethereum option growth rates outperformed Bitcoin option growth rates by about 3.6 times for 2020, and a similar outperformance of Ethereum future volume growth rates when compared to Bitcoin future volume growth rates can be observed, which is about 3.1 times higher, the growth rate itself for Ethereum futures volume growth versus Bitcoin futures volume growth. And finishing with options here, Deribit had about 90% market share of all the total trade volumes for the options here, which is important given the high growth rates for 2020, and this might change going forward depending on how Binance moves into the option market. And most of these metrics you can, and more, you can also see on the data dashboard for free, as I mentioned earlier. So yeah, with that, I will give it to Ryan.
Thanks, Lars. Okay, so I'm going to dive into this and try and fly through these as fast as possible. If there's anything that you want to see more data behind, or if you want to just talk about this topic, always happy to do that offline. So starting off with funding trends, in general, I'm going to be covering just the uptick in public and private market activity that we've seen for this asset class. It's a pretty general consensus view that all of this is going to continue to go up and to the right, but going to just point out some trends that we saw in 2020 and what we've seen so far to start January. But in 2020, venture funding into what we call crypto and blockchain vertical. This is data pulled from Crunchbase and PitchBook and cross-checked via our own internal sources. This funding, venture funding, financing was fairly consistent in 2020 versus 2019 in terms of dollar volumes. And what's kind of notable about this is we saw a 61% drop off in total funding due to the COVID pandemic in Q1 and Q2. So the fact that it was able to at least match venture funding at 2019 levels was pretty impressive in our view. But in aggregate, roughly $3 billion was allocated to what we call crypto blockchain projects at an average deal size of 5.7 million. Something to call out here is the median size was much lower at 1.8 million, which kind of speaks to the market being pretty top heavy. And when we speak about fundings and financing, it's going to be dominated by a few key deals. But an interesting point also to point out is historically, when we look at over the past 5 to 6 years, funding into this industry tends to lag previous bull cycles. So we saw the price of Bitcoin and the total market cap of crypto top out right into 2018. And 2018 is when we had the outsized funding year, which is kind of what the expectation is set for this year going into 2021. We're seeing all-time highs, as Lars called out, across not only prices but fundamental factors. This obviously increases investor interest in the space, not only in the public markets, which we'll get to in a sec, but also in the private markets. I think, again, not going out on a limb here, but just considering the Coinbase IPO, just the general public markets activity and conversation that's evolving, the expectation for M&A to finally see a massive uptick in 2021. All this is to say that 2021 is poised for a record capital accumulation for this industry. I'll skip over basically M&A, similar to funding. Not much to really call out here, other than 2020 actually recorded the most M&A transactions in the sector's history. Again, pretty interesting with COVID in the backdrop there. But in terms of dollar-sized deals, and then this follows the financing trends that we've observed, the bulk of the largest M&A deals still come from that 2018-2019 lag from prior bull market cycle. So in line with how we're viewing financing activity, we do expect, like many others in the industry, to see an uptick in M&A this year, especially as we see larger financial institutions, the rumors of PayPal sniffing around the space, as they look to expand these crypto capabilities. Our expectation is that they would rather look to partner or acquire rather than build in-house. Now, I think what's really interesting about the setup for 2021 in terms of public and private market activity around this industry is obviously the gorilla in the room, which is Coinbase IPO or direct listing. But also this new hot trend we're seeing in equity capital markets around special purchase acquisition companies, also known as SPACs, and bringing lower quality or harder to access public market companies that have harder access to traditional public markets, bringing them public. And I think Coinbase aside, obviously the funding that transaction will bring in alone will reset the historical funding for the space in the industry, and will clearly reprice with its valuation, whatever it lands at. Will have an impact not only on the exchanges that it competes against, both centralized and decentralized exchanges, but it also helps to reprice the other business segments it touches, whether that's custody, institutional products and services, banking and payment services, the whole lot. So that aside, I think, getting on the SPAC trend, Bakkt yesterday officially filed with the SEC to be acquired by Victory Park Capital at a $2 billion valuation. Not going to really comment on the deck that has been passed around at length yesterday, largely because the entire thing was forward-looking. There was no historical, so nothing really to comment on there. But I think the main takeaway from the Bakkt story is that a pre-product, pre-revenue, digital asset company, or even I guess digital asset product, if it can get away with comping itself to the most valuable fintechs in the world, priced at what I calculated, I think is 36 times forward-looking 2021 price to revenue multiple. If this can fly, and more power to them, like if they can command this rich of a valuation at current financials, more power to them. But if that can fly, then the question then becomes, what will a business that does, say, 100 million in revenue in 2020 go for? And I think that's the conversation we're seeing happening right now, specifically in the private market, off the back deal. Sorry, my phone froze. Okay, and I think, you know, we can put, you know, where your opinions are on the valuations aside. I think it's interesting to see what's happening in the public markets, and it actually suggests that maybe the back deal isn't as crazy as many believe. You know, we're currently seeing pretty much all the public, what I call pure play crypto companies that are publicly traded, both in Canada and in the US, whether it's the mining companies, which tend to be lower quality, at least in terms of reporting standards. All of them actually, for the most part, outperformed Bitcoin last year. When you look at Galaxy Digital, which touches every type of line of business. You know, Riot Blockchain, I have no idea what they do, but they were up 1,800%. Even Silvergate, which now is $1 billion company, was up 360%. It's interesting to see these pure play crypto public companies have this record year and outperform Bitcoin. And it tends to also drag up these private market valuations because of that. And I think one last thing to call out here is we all know the MicroStrategy story quite well. But I think seeing Morgan Stanley Investment Management arm top up its ownership in MicroStrategy to 11%, the second largest shareholder behind BlackRock now, hedge funds like Rentech becoming a top 10% owner in MicroStrategy after they announced, or actually they did that the month before MicroStrategy started buying Bitcoin. Kind of speaks to this demand currently in the public market investment landscape for Bitcoin exposure. So that's definitely something to watch for this year. And then real quick, and I'm going to pass it on in interest of time, but really nothing speaks to this demand for this Bitcoin exposure than what we're seeing right now across the three core products, or I guess two core products that give you that exposure. You know, we hear stories all the time of new records at Grayscale. I think something that people don't realize is it's now one of it's probably the number one. I haven't rerun the numbers in January and December, but it's a top 3 OTC traded ticker in terms of volume. And if you check out the block dashboard, you could see that we estimate that Grayscale made roughly 30 million in revenue off their products in December alone. And then kind of moving on to CME, you know, it continues to be our view that the CME Bitcoin futures product is this best proxy for measuring growth and institutional trading activity around Bitcoin. And something that I always like to call out on this point is the product actually had more than 100 total reportable large open interest holders. Kind of a mouthful there, but that's at least anyone that has open interest of at least 5 contracts, which is 25 BTC. A contract is 5 BTC each, gets counted as that. And that actually placed the Bitcoin futures product within the top 80th percentile of all CFTC reportable futures contracts, which is, you know, a success in its own right for the CME group alone. And it's going to be quite interesting to watch what happens with the CME ETH futures product. If it can even half the activity in the 2 years that Bitcoin's done that for CME, it's going to be a successful product in its own right. And then the last thing just really to call out is, you know, the net effect of all this activity is in 2020, we saw what I like to call the banner year for financial services, laying stake and building out their own offerings to target this industry. But that's on like the operational side and revenue side of traditional financial service models, I think this year is obviously setting up to be the first real year we see the capital market side of investment banks and other institutions really pick up and target these trends that we've seen in public and private markets. And with that, I'm going to pass it on.
Thanks, Ryan. Hi, everyone. I'll be talking about the primary lessons we can take from 2020 with regards to DeFi, and just give a few overview stats on how the year has gone, and then talk about what we can expect in 2021. And also, this part of the presentation is sort of simple on purpose, where it's just a wrap up that really tries to put together the key lessons and numbers from the past year. And if we look at 2020 for DeFi, it's really the year where the framework for how crypto protocols should be thought of became much clearer. So in 2017, as the ICO boom took off, we didn't know how tokens should even be valued, and there were these relatively wild ideas about like token velocities and stuff like that, which would not have been defensible in the context of like ideas in traditional finance. Most thought of tokens as currencies, and now it has become clear that protocols should be valued based on the cash flows they produce to their owners in the future. And also the idea that tokens are a lot like equity has formalized, where the token is for governance, and ultimately governance equals every other feature. If you want to pay dividends, change how the protocol works, or anything else, it happens via voting with tokens. And with the chart on the right, I want to illustrate how most of the technological progress goes under the radar, whereas the financial innovations are the ones that really kick off periods of growth. So some of the largest project launches and decentralized applications that are popular today actually were launched a while ago. This refers to projects like Uniswap and Compound V2 or MakerDAO's multi-collateral DAI. And what really pushes them forwards in terms of dollar value moving through these protocols are the innovations and the financial incentives. And these innovations have tended to reflect ideas from traditional finance. And we can see a pattern where crypto sort of discovers something from traditional finance, then takes it way overboard until at the end we get measures to sort of start making more sense out of them. In 2017, it was ICOs and the simple concept of ownership that was really powerful and played a big part in the bubble. And the latest kickoff in volumes was started during the summer by Compound's yield farming incentives. And this can be thought of as sort of a hybrid of VCs subsidizing marketplaces and employee stock options. But instead of employees, we're now talking about a global pseudonymous group of online users. So when Compound launched their liquidity mining program, that's when you see the total value in DeFi grew from about 1 billion to 15 billion very quickly. And as a part of the pattern, there's a bubble that pops because the phenomenon is not sustainable. And this time it was the 4,000% API yield farms with semi-Ponzi token economics. And once the bubble pops, we start seeing the adoption of more sensible practices. In the case of ICOs, this was something as simple as building investing contracts into the current token models. And perhaps the most recent idea from traditional finance that we're starting to see is now Yearn's M&A, where they're creating this sort of ecosystem of protocols that work together. Though this is not real M&A in the sense that ownership of protocols is not being transferred to another group of token holders, but it does conceptually resemble the first steps of such activity. So in summary, technology improves steadily, but financial innovations really pull fuel on the fire and drive periods of high growth. And just to go through the large categories in DeFi, the key theme for DeFi really is that now success is measured in the billions. So DEX has had about 3 billion of trade volume in 2019. In 2020, that was 116 billion. Automated market makers, so this is like Uniswap and Curve and SushiSwap, make up about 90% of the market. Uniswap has been really dominant previously with 60% of the market, but now also Curve and SushiSwap have both carved up about 20% in the past few weeks. And in some sense, DEXs have become quite competitive compared to centralized exchanges on the spot market. In September, Uniswap momentarily passed Coinbase in monthly trade volume, which was a really big deal. And even today, if you take a look at what the slippage is on a given trade on some of the major pairs like ETHUSD, you can get DEXs that are quite competitive to even the top centralized exchanges. And DEX aggregators like 1inch and Matcha grew from 0 to 10% of the market, though I'm going to be talking about a bit more later about why those could be in a bit of trouble as the technology progresses. L2 solutions for now have not really been popular. However, this could start changing very quickly, as for example, DYDX is planning to move to ZK rollups, and Uniswap is expected to integrate with optimistic rollups soon as well. Based on the most recent data, DEXs are seeing all-time highs in trade volumes. However, they've actually grown much less recently than the centralized counterparts in the past 2 months with the bull market. So we have this chart on the data dashboard that shows the ratio of decentralized exchange volume to centralized exchanges, and that was at about 15% at its peak in September, and now it's around 5%. Then the other major category in DeFi, which is lending. And first here, I want to note that every basically parabolic chart in DeFi starts when Compound's liquidity mining program started in the summer, and this is also the same for the lending boom. So right now there are over 3 billion in outstanding loans across the 3 major protocols, MakerDAO, Aave, and Compound, and this is up from about 100 million a year ago. There is this caveat that a lot of the initial Compound's borrow volume came from DAI, and this is because people would build these debt pyramids from DAI to liquidity mine Comp. But recently, we've seen USDC become a much bigger part of Compound borrowing as well. And during the summer also, the demand was so large for leverage trading that MakerDAO really struggled to maintain the DAI peg at $1, despite making leverage essentially free with 0% interest rates. And a couple of the other smaller categories to show are prediction markets. Prediction markets generally saw like some tens of millions of volumes across different platforms during the 2020 election market, with the current top Polymarket 2020 election market having 28 million in trade volume. And there the question really is that will these protocols be able to grab similar interest on other markets when there isn't such a huge one-off event? Secondly, privacy is becoming a bigger deal. So Tornado Cash recently reached 100 million in TVL in their ETH privacy pool, and this also shows the power of financial incentives, where the Torn token is distributed to users who provide liquidity there. BTC and DeFi was a big theme during 2020, but really the BTC denominated growth stopped also when yield farming ended, and since then the market has remained pretty flat. Looking to 2021, the big maybe 2 themes are the integration of layer 2 and then derivatives protocols. And in presentations like these, it feels like people have promised scalability every year for a couple of years now, but in this case, really the most difficult computer science monsters have been sort of defeated, and now we will see the results in practice. So for example, already Polymarket is running on Matic, which is a layer 2 sidechain solution. And additionally, like the decentralized exchange Loopring is built on ZK rollups and has facilitated some hundreds of millions in trade volume. Further, almost every DeFi project has announced plans to integrate with a specific scaling solution, and deployments are expected in some cases within weeks. So DYDX is planning a move to Starkware ZK rollup based StarkX, and Curve is also building on ZK Sync by Matter Labs, which is another ZK rollup solution. And Optimism, which is built on which is optimistic rollups, is launching in January, and that's where Uniswap and Synthetics, for example, are expected to migrate or at least have new deployments. So in short, many projects will be on layer 2 or a sidechain already early in 2021. And from a user perspective, this is really good because it gives instant and near free transactions with an application, but it also has this fragmentation, which is a minor downside. So most services will have a deposit and withdrawal user experience, which is different from what users are used today, where everything is sort of a single click via Web3 wallet. And further, the bigger problem is that this sort of breaks composability. So for example, something like DEX aggregators don't actually work in this environment because applications are siloed into these different environments. Ultimately, this may play out in a way where most applications migrate to the same L2. And for example, we've seen like rumors of the Yearn ecosystem players wanting to migrate to the same ZK rollup once that becomes available. Like I previously mentioned, the decentralized exchanges have become competitive to centralized exchanges on like the spot volume. The next natural step is to grow that, grow the success of DeFi to the derivatives market. And this really means perpetual swaps, futures, and options, and sort of prediction markets can be considered in this category that will be ported over to the decentralized and non-custodial world. With the right protocols, the decentralized exchange market can expand to leverage and synthetic products. And synthetic assets, for example, are really interesting because they open the avenue for all assets to be traded permissionlessly on blockchains, not just as tokens, but for example, stock and commodities futures. The challenge for these derivatives exchanges will be the same as has been for DEXs, which is forming liquidity and being competitive against centralized counterparts. Here you have sort of competition split between different order book-based solutions like DYDX and DerivDEX, and something like Perpetual Protocol, which uses a mechanism that's a lot more like Uniswap when it comes to building liquidity. And these decentralized derivatives will add another level of sophistication into crypto-native DeFi products. And a success for these protocols would really be start to have that same hundreds of millions or billions in trade volume at the end of 2021. And if by the end of 2021 you have activity that's also like major trade volume in, for example, S&P 500 derivatives, that would be a really big success. Thanks, and next up is Mike.
Thanks, Mika. Hello, everybody. My name is Mike Rogers. I mostly cover the regulated forms of digital assets, so digital securities, central bank digital currencies, and stablecoins. I'll be going over the Stable Act today. My most recent research piece that came out this morning was part of a two-part series on the Stable Act proposal. And for those that are 90s kids, you might recognize the Schoolhouse Rock for the process of how basically an idea becomes a bill and then how it eventually becomes signed into law. So like anything, there's usually a prologue or just basically an environment and series of events that is up to the point of a bill or pretty much a major event being created. It doesn't just drop down out of nowhere. So one of the things that we covered in the year-end report, specifically in the macro section, which I wrote, was about Q1 2020's historic decline. I've covered it in a lot of my columns in the beginning of the year when it first started here. A lot of it had to do with basis trades that hedge funds were making, which is basically using leverage for spreads on treasuries and other forms of debt. And basically that's what kind of, once that kind of blew up, it led to the historic decline when credit markets got tight in March. And I mean, we covered it in the research piece for the end of the year, where the scale of the Fed's monetary policy response to kind of add liquidity to the system and get serve as the lender of last resort really helped open things back up. And that's how all markets were able to kind of reflate in the second half of 2020 and continue to do so to this day. But one thing that basically was proposed was the Mint the Coin proposal, or the ABC Act, and that was another form that was unconventional. That made a lot of headlines, and that's actually something that has a lot of overlap with the Stable Act, and that's something that I'll go over in the coming slides. Another thing that's really important to look at is the spat that's currently going on between lawmakers, which have to do with the ABC Act, as well as the proposal for the Stable Act. A group that's kind of overlapped with both also has given pushback to the OCC, basically for their two interpretive letters that were issued in July and September of 2020. And as some might be aware, I think I saw a question in there about the OCC's most recent letter. There was another one that was issued last Monday on January 4th. So there's been three pretty important interpretive letters that came out of the OCC recently as the Trump administration makes its way out and the Biden administration makes its way in. So starting with the ABC Act proposal, basically in the heart of everything that was going on April 16th, and its representative Rashida Tlaib is basically the one that is one of the common denominators behind the ABC Act, the Stable Act, and she's also on the letter that was sent to Brian Brooks, the head of the OCC. Basically, this made headlines for digital dollar. Anything that has to do with digital dollar, even though the mechanics behind the scenes weren't anything like a lot of the other proposals that the Block Research has covered, specifically in our central bank digital currency white paper, which Ryan and I co-wrote and really had a lot of coverage last year. And I would definitely recommend that everybody check that out, because it's kind of a lot of the monetary authorities, what they're working on behind the scenes. And we kind of shed some light on a lot of the top proposals. And I also write a column called Fiat Freeway, which is every week discussing the most recent stuff with central bank digital currencies and as well as stablecoins. So basically, it was nothing more than really a headline with digital dollars. It was using digital debit cards essentially. But it did leave in the proposal, it left it up to kind of convert the infrastructure over the long term, because it seems as if central bank digital currencies, especially in the developed nations, are a long way off from being viable for, say, using for citizens of over 300 million people like we have here in the United States. But, headlines and getting things on the legislative agenda kind of helps for establishing precedents for later on. So this is kind of just a review, because, even with the headlines, when things make their way in, I mean, there's such a legislative process that has to go through for a bill. Like, for instance, the current proposal for the Stable Act is really kind of in between the idea and bill stage right now. That's kind of where it's at. It hasn't even been introduced to the House of Representatives yet. Realistically, it wasn't going to be, because it was proposed, like the discussion draft was released on December 2nd. And I mean, that was literally a month before the 116th session of Congress expired. So basically, that it wasn't going to be signed into law before then. That's actually what happened with the ABC Act. It died in the 116th session of Congress, which is about to come to a close. So basically, as I'm going to go over in the next slide, it was introduced to the House of Representatives, the ABC Act, and it made its way to committees, and then it basically just died there. It never went to the House floor for a vote. So that's actually what happened with the ABC Act proposal. Representative Tlaib introduced it to the House of Representatives, and it became HR, which stands for House of Representatives, Bill 6553. And you can see the co-sponsors there. Make note of Jesus Shore, because he's also on the Stable Act proposal. And then you'll see also the two other members of what is termed in the media as the Squad, with AOC and Omar as well. They're also, I believe, were on the letter signed and that was sent to Brian Brooks. So I mean, there's clearly those that overlap with a lot of the ideals. They're kind of on the same path, I guess you could say, with what they believe should be happening. So basically, the HR 6553 was sent to the House Committee on Ways and Means, as well as the House Financial Services Committee. And as I said before, it never made its way to the House floor for a vote, so it basically died. And the other event for the prologue to the Stable Act that was important is the OCC's interpretive letters. The first one was in July, and it basically concluded that national banks were able to custody digital assets. Where we've been in kind of the life cycle of our industry, for anybody that's been here for the past several years, it's a lot of basically how do you build the on-ramps to get into the digital assets ecosystem, and specifically what are the regulations and policymakers and things are becoming more clear. So that's kind of what was great about these two interpretive letters that were released in the second half of 2020, because the other one that was released on September 21st, it basically gave guidance on holding reserves in accounts for customers of banks and savings associations. So it was nice because for our industry, we were getting more clarity. We've kind of had guidance, and a lot of us, and why I focus on digital securities, coming from a financial services background before coming to digital assets, I worked at Blackstone. Basically, those are the things that we really want to focus on, and it's nice that we had guidance, and this specifically helped give more clarity. But unfortunately, the group of lawmakers from Congress, they didn't really feel that way. They criticized it. They basically felt that digital assets are too important for the future of banking for the OCC to have made that decision on their own. Congress wants to be more involved. And basically, something that I've written about in my Fiat Fury columns, I've been tracking this for the past several months. The OCC set a set of 8 questions that they sent to Brian Brooks on the 10th, but realistically, it seems like it was just a formality because before they could even respond, Representative Waters sent a letter to President-elect Joe Biden that criticized the OCC. Basically, she felt, and those that signed it as well, that under the Trump administration, there's been regulation that has been rolled back in their minds that is kind of disguised as innovate in the purpose of innovation, but they feel as if it only benefits a certain group of people. And under the header of attachments entitled digital banking, basically Representative Waters recommended that under the Biden administration that he, when he takes office, rescind those 2 interpretive letters that the OCC had on digital assets custody. And what makes things even more interesting is that as all of that was going on afterward, basically the OCC came up with their 3rd interpretive letter. So when they unveiled the Stable Act proposal, basically the whole idea behind it is to protect low and moderate income communities, which they feel that technology companies and fintech companies are exploiting, and that COVID-19 kind of has exposed some of the infrastructure gaps for access to financial services. And realistically, digging into the backgrounds, it looks as if Professor Rohan Gray is kind of the common denominator. If I were to bet, I would probably say that he, looking at some of his public posts and how deep he gets into everything, that he probably helped create the foundation of the bill. So here are the 4 major requirements, and they have to do basically mostly with issuers, 3 out of the 4. But the other one that really leaves a lot of things open to interpretation, and what many people within the digital assets industry are kind of a little worried about, is node operators and kind of financial services providers, because it's very vague, and it's the beginning of a proposal, so it's gonna be vague. But realistically, how can say a protocol like Ethereum apply for a banking charter? That's what many people kind of are wondering in that sense of where, if it were to be interpreted certain ways. And this is kind of another digital asset community reaction. I mean, it really, it's claimed to be one thing, but it's hard to see how it would help certain members of disenfranchised communities, when realistically it seems like more so that it helps provide a kind of a moat to those that are already financial services institutions that in the press releases they're kind of criticizing, but ipso facto it essentially provides them with a deeper moat, and kind of that's really kind of the issue there. And that's likely what the motivation has been for recently digital asset firms like Paxos, who have the trust charters, which is kind of like the most regulated version that many companies like, say, Gemini with their Gemini dollar and USDC from Circle, they all issue it under trust. But now we're starting to see some of these trust companies apply to become regulated banks because maybe they're potentially worried about where the regulatory environment might be heading. And this is stuff that we could cover more, and I'll be covering in my future research pieces, and happy to answer any questions. But yeah, I got to wrap up here, and I'll turn it over to Larry right now to kind of assign the questions.
Yeah, thanks, Mike. So we've got a lot of questions, and we're already running out of time quickly. We're going to go over, so if you want to stick with us, you can. This is also going to be uploaded on the site along with the slides and everything else. So if you want, you can stick for the questions. We're going to go through them really quickly. The ones that we don't get through, we might be able to answer on Twitter or answer on the post that we update this with. So the first question was mainly targeted at me, and it's basically asking about Tether and what led me to change my mind. So I used to be fairly skeptical of what was going on there, mainly because Tether was just extremely not transparent with everything that was happening. The reason why I've changed my mind personally, it would definitely take a long time to explain this in a lot of detail, but basically I've talked to a lot of third parties that have redeemed tens of millions of dollars successfully, that work with Tether every day. I've spoken with Paul a couple of times, really one of the most hard working people in the space. And I just changed my mind because the answers that they were provided to me where I had the most doubt were convincing. And I actually did a debate on this last week that ended up being like an hour long, and it's going to be released in a podcast form in about a week. So you can listen to that in detail. I just don't have much time to go over this. This is such a complex topic. And I think because it is a little bit more complex than people realize, some people are skeptical for the right reasons, but the more you look into it and the more actually you talk to people that deal with Tether and the executives there, the less doubt I personally had. And I think this would be similar with other people. That being said, one thing that I'll say is that I think at this point there are two main issues with the crypto space, or two main potential massive issues, and that's Tether and Binance, because both of those are extremely important to the space right now. Binance does, the vast majority of spot volume right now, pretty much the most important futures exchange, and it's just such an important player right now. And so if Binance went down, it would definitely cause big problems to the space. And I think the same can be said about Tether. I don't think that anything that's going on there, right, is fraudulent or there's some issues. But if a U.S. regulator really decides to do something, they can easily, I think, at least take it down. And I don't think that there's a high chance of that happening, but it's possible. And it's important that people realize that that's something that is important to be prepared for, and for Binance as well. I think both of these are fairly low chance, especially this year, but it is an event that people need to pay attention to potentially and be prepared if something were to happen. So another question that we had was about retail investors and options on Bitcoin, and how they function and if retail can invest. I think Ryan can jump in here for this one.
Sorry, working this on the phone stuff. Long story short, answer is definitely yes. Basically the biggest requirement, there are options on CME now on Bitcoin. When we're talking about CME, the reason why we think it's more institutional proxy is just the requirement on contract size. So CME options, like the CME Bitcoin futures, one contract equals 5 Bitcoins. And so as Bitcoin continues to rise in price, that gets prohibitively expensive for retail. If you assume 35K price, that's roughly 175K position size out the door per contract. But there are other non-regulated offshore exchanges, as we call them, Deribit being a big one. And you can actually look, this kind of gets to what Mika covered, but we're even starting to see DeFi protocols enable option functionality in products through smart contracts. So Open and Hedgic are two examples there.
Cool, thanks, Ryan. One quick follow-up question we got on Tether, the developments coming up on January 15th. So as far as I know, and I think most of the people on the call will agree with me, is that January 15 really isn't a big event. It's basically the deadline for Tether to hand over the documents. As far as I know, they've complied to that already. I'm not expecting anything crazy to happen. And I think that it's going to take obviously some time to go through all of those documents, and but ultimately I am convinced that Tether is not doing anything fraudulent. But moving away from Tether, I mean, again, this is a super long discussion. We have a question about DeFi for Mika. So when can we expect institutions coming into DeFi, and if there are already some institutions that are interested in DeFi for you, Mika?
So a good separation here is probably more crypto native institutions who are participating in, for example, like borrowing from Compound or supplying to Compound or liquidity mining specifically versus like traditional institutions who are like just making basic BTC allocations. And there, the market dynamic is sort of one where institutional players, like the large ones, do get actually the yields from, for example, liquidity mining, and where the yields are reflected in the lending interest on institutional lending desks. And the crypto native firms that are able to make a profit from these liquidity mining activities are the borrow side, and then borrow the capital from traditional investors who can't get in on the action. And the larger institutions really have this sort of fundamental issue where they don't know who the counterparty ever is in a DeFi trade. For example, if you just make a DEX trade, you don't know who's on the other side or who's providing liquidity to you on Uniswap. And there are these ideas around having KYC pools, but this sort of destroys also some of the biggest value adds of DeFi, which is a global liquidity pool that anyone can contribute to. And also participating in DeFi is also a large risk management issue, because you have to understand things like what are the liquidation risks when there's congestion on the Ethereum chain, what are the smart contract risks. So I would say a lot of institutional participation is about comfort, because there's just, when something goes wrong, there's sort of no one to sue. So I guess it's going to be like a longer journey to get like actually large institutions to use them directly, but they do like participate in the market through this indirect way.
Cool, thanks, Mika. Another question that we have is if Ethereum is seeing public market interest similar to Bitcoin, and if we anticipate the interest to grow or potentially surpass Bitcoin due to DeFi innovation. I can quickly answer this. I don't know if Ryan or Mika want to jump in afterwards. But, I think it's important to define what public market is. If you're just talking about like people in public interested in Ethereum, then I think, yeah, there's obviously a lot of interest. What I'm not seeing though much of is interest from actual like macro investors and institutional money interested in allocating a lot of money to DeFi. I think the vast majority of this rally in the last 2-3 months has been driven by Bitcoin. Bitcoin has basically led the market in movements, and even talking to and anecdotally knowing what kind of investors are investing to what, I'm only seeing them allocate significant capital to Bitcoin. Ethereum, however, is much more popular with the retail crowd right now, relatively to the market cap at least. So if you look at like Google searches and Twitter followers and all kinds of retail metrics, Ethereum is still much smaller, but it is kind of catching up. And that's mainly because of DeFi and how interactive it is and how you can actually use it versus just have it sit somewhere. And I think a lot of the rise is caused by, Bitcoin holders actually ended up like cashing some of their gains and then, hoping that that if they put it in Ethereum, there's going to be higher returns and similar to DeFi. So I'm not seeing much interest when it comes to actual institutional capital, but it is definitely important on the public markets, and I think it's not going to surpass Bitcoin, but it's definitely more exciting for normal people that want to interact with the protocols. I don't know if Mika or Ryan, do you want to jump in briefly here?
So one sort of narrative that hasn't really taken hold, and maybe this is something I sort of talked about in my DeFi presentation, is like this idea about DeFi protocols producing cash flows and becoming like tokens being productive assets. And that's something that hasn't really permeated yet through like the mainstream, but sort of that's an interesting narrative once it sort of does, if that changes the mind on institutional allocation into DeFi as well.
Yeah, I agree. So we can go to the next question, and that's if there's real trust and optimism, Ethereum's layer 2, and if it's going to deliver something that works after the same team flop on Plasma, which promised the solution by Vitalik 2 years ago. Seems like people have short memories. So Mika, again, if you want to jump in here.
Plasma really ended up being this sort of never-ending hole of technical complexity due to something called data availability problems, which basically, the short of it is, has to do with the fact that Plasma is conceptually really efficient scaling solution because so little data about what happens on the L2 is posted on the L1. But the data availability problem has to do with like the actual security around that. And it wasn't actually only optimism. So for example, Matic, which worked on like Plasma Solutions, is now basically a side chain that has its own sort of trust assumptions and doesn't really get its security from the main Ethereum chain. So optimistic rollups, they actually should work because they sacrifice something like an order of magnitude of scaling to make this data availability issue go away, where you post enough data on the Ethereum main chain to reconstruct these proofs of transaction validity. So it's sort of complex, but the end result is that if Plasma can do 10K transactions per second, optimistic rollups maybe can do like 300, and that's more than enough increase for now. Yeah.
Cool. We have one question about privacy coins and delistings related to privacy coins that was started by Bittrex. And then also some dark markets using Monero. So we don't have a particular insight here for why Bittrex delisted all the privacy coins, or at least the main ones. That being said, there are a lot of regulatory developments that make privacy coins difficult to exist. Something like Zcash is more likely to exist because it also has 9 private transactions, but like the pure privacy coins don't exactly go with the regulations that are coming up. Global anti-money laundering regulations, where you actually have to identify who the transaction is going to, at least, and that's not possible with completely private stablecoins. So my opinion on this, and it's only my opinion, I'm not totally sure, but I'm almost convinced that in the long term, pretty much all exchanges are going to end up delisting most of the private privacy coins that have the most robust privacy features, and that's mostly because the current financial system is just not compatible with full privacy. And even though I think that that's unfortunate, that's what it is. And so I don't think that long term they're going to survive on these exchanges. The question is maybe like what the impact will be of that. Initially, when there weren't that many exchanges, people were exchanging bitcoins by just meeting and exchanging for cash, local bitcoins and other platforms. And I think if privacy coins will survive, like Monero, which is now used at a lot of the dark markets, they will have to adjust in some way. Maybe at some point there'll be a decentralized exchange or something, but that's really difficult with fiat as well. So I'm personally not super optimistic that they will survive on exchanges. Not sure about Zcash, since that's a little bit more complicated, since they also have public transactions. But this is a really complex topic. We don't have that much time to go into it. And another question that we had was what has been the advancement on CBDCs, and if there's a clear winner, and finality seems to be used and win contract in the West, but what about the East? And I think Mike Rogers would be the best person to answer the CBDC question, maybe Ryan as well.
Hey, thanks, Larry. Yeah, so I responded to that question in the chat, but specifically, yeah, some people want to make it out like it's a space race, but it's not necessarily like that because technology doesn't really, in and of itself, make a currency or kind of shift the global reserve currency status or anything of that nature. I mean, realistically, the U.S. Dollar is 60% of global debt denominations. Plus, we have the petrodollar system and other factors like that. So it's something where you know, a lot of the media and, you know, people that are pushing policymakers for maybe their own agendas kind of make it out to be like that, but I don't necessarily hold that belief. There's not really a winner right now because most developed nations are taking a pragmatic and patient approach. The majority of the progress that you'll see is with pilots and those that have live implementations, like say the Sand Dollar in the Bahamas, those are in developed nations, which in the Central Bank Digital Currency White Paper, which again, I'll post the link in the chat. But basically, the way that that's set up is that I think that a lot of the developed nations kind of see and observe, and that, you know, central banks share a lot of research and data, and they'll probably use the developed nations as like a testing ground before implementing something in, say, again, a country like the United States that has over 300 million people and that has the global reserve currency status. There's not really a need to rush because it can only hurt you if you transition everybody to a specific system and then you know, you don't have all the bugs fixed before rolling it out on nation like ours, then yeah, it can only hurt you. Well, one thing specifically though that we have seen is that there's a lot of progress and pilots that are being conducted over in China with their DCEP system, which I've covered in Fiat Freeway. I had a whole issue on that, and I'm going to be writing over the coming weeks on some of the progress there. But basically, they're starting to do some rollouts in certain cities. But realistically, it's also what's actually under the hood and how much different is say DCEP from kind of some of the other databases that are used with central banks currently, and is it really what some might envision when they think of a CBDC? So that's kind of the overview right there of progress. I'll post the link to the Central Bank Digital Currency White Paper and some of the other things that I've written on this.
We had another question about stablecoins and what we anticipate this year. So I can quickly answer it as well. We are actually working on, almost done with the stablecoin report that's going to be published by early February. So that's going to be a really comprehensive look of the growth and the outlook for all stablecoins. But for me, really, you know, massive growth last year. We've seen basically all the metrics that we track, like 3 or 4x growth last year. More than $1 trillion in the total value settled on chain, which is just insane in itself. But for the growth, you know, right now the majority of the product market fit is still in trading, the vast majority, and you can see that with Tether domination. What I think will change this year, I think that the growth will continue as the crypto space grows further. There's more demand for Tether and for other stablecoins. But I think the biggest thing this year will just be looking for use cases other than trading. And I think they can start with FX, which is the most natural transition, but eventually just go into like payment use cases and using stablecoins to, you know, deposit money to a bank. And you know, the DM will launch at some point in the next like 3 or 4 months. So that's going to be that's going to have a big effect, even if it might fail. It will bring a lot of new capital and on top of that, we have other players like PayPal considering a stablecoin internally, and then, you know, GMO just announcing their stablecoins as well, which are one of them is actually Japanese yen as well, not just US dollars. So I think that's going to be the biggest difference this year is that, yeah, a lot of it will still be trading, but we will start finding use cases for stablecoins on top of just trading, and I think that's going to be exciting and will bring a lot of new interest. So that's that. And then I guess maybe the last question. I'm not sure, Mika, if you're 100% caught up on this, but it's about the guest post at Financial Times. I think that was just published on DeFi. If you have any opinions there, like DeFi basically, the returns in the past like 3 hours have been crazy, and it seems like DeFi in some ways is reaching mainstream with that article. So if you have some opinions on that.
No, I don't.
Okay, so in that case, we do have a whole bunch of other questions, but I don't think we just have time to go through all of them. There's some interesting questions about like competing L1s, Polkadot, and different L1s competing against Ethereum, but I mean, it would just drag on too much. We're already 20 minutes over the time, so I would just like to thank everyone for attending. Thanks for sticking all the way to the end. We will be uploading all of this on the Blocks website, including the slides, including some of the questions that we didn't answer. And if you still have some questions, tweet maybe or message us privately, and we can answer everything there. Please check out the data dashboard. That's really a product that all of us are super proud of. Like I said, we've added almost 200 charts at this point and adding more every day. And so if there's something that you still don't see and you would like us to add as a chart that dynamically updates every day or every week, please let us know. We want to make this as useful as possible. It's freely available to everyone. And just use the product and let us know how it is. We want to make sure that it is something that's really useful to everyone here. And if you're still interested in the research product, you can message me, you can message our sales team, you can message really anyone, and we can introduce you to people that can get you the access to the Block Research membership. And so that's really it from me. Thanks, Lars, Ryan, Mika, and Mike for doing this with us, and thanks for everyone for attending.